Hi, I'm Lisa Wilson, and I will be presenting Elvis and Adele Singer's financial plan. So this slide just goes over the family summary data, and it shows you the age, marital status, children, net worth, income, whether or not you're self-employed, and your life cycle. Here on this slide discusses your financial planning goals and your concerns. So you would like to save for each of your 3 children to attend a private university. And you would like to pay off your mortgage and the HELOC before retirement. You would like to retire at age 62 with a 70% pre-retirement income, including Social Security, which is expected to be $30,000, so 20 to Elvis and 10 to Adele. Your life expectancy is 91 for both, and you would like to have an appropriate risk management investment and estate planning portfolio. And so your case assumptions, so you both live to 91, you both have moderate risk tolerance, and you require a 8.5% rate of return. Both you and Adele would like to retire at age 62 with a 70% pre-retirement income with Social Security of $30,000. You want to refinance your existing mortgage and roll the cost into the refinancing amount. You want to fund each of your kids' private education, and if tax withholdings are not close to liability, you're willing to change to a W-4. In the beginning of the year, your assets last year, including cash, were $228,413. The total assets was $785,665, and your net worth was $548,852. And furthering on with the case assumptions, this just shows you the investment return expectations, and so you can see the return percentage and the standard deviation percentage. And here we go over the education information that all 3 of your children show musical promise, and Bing, who is 16, wants to go to a private university. Celine, who is 13, would also like to go to a private university, and Shania, 11, is undecided. So for your risk management issues, we suggest that you increase your homeowner's insurance to $272,000 to meet the 88% coinsurance requirement, and to consider increasing Elvis's life insurance to $1,662,000. Your auto and personal liability umbrella policy are both adequate. And your long-term disability, you should probably consider increasing Elvis's disability to $6,925 to meet the 60% wage replacement ratio. So that way, if anything were to happen to Elvis, 60% of his income will be replaced. With the estate planning, we recommend that you have the advanced medical directive and durable power of attorney documents drafted. So for your debt management and increased savings issues, we recommend that you refinance your mortgage to a 30-year at 4% rate and roll the closing costs into your loan, and to consider selling a portion of Dell's stock and use the proceeds to pay off the home equity line of credit and your auto loan, and to cancel the home equity line of credit. So the long-term goals issues is that it will be very difficult for you to retire at age 62 with a 70% wage replacement and fully fund all 3 of your children's private education. Because achieving both of those goals, you would need to save an additional $195,509.93. But we do have alternatives to discuss on the next slide. So you mentioned that Adele might be willing to go back to work as a vocal coach, and if she can earn $50,000, this next option, with the additional income and a slightly more aggressive investment strategy, giving you a portfolio earning of 9.8%, you can retire at age 62 with a 70% wage replacement, and the additional income will enable you to contribute more to your retirement savings, increasing your current annual savings to $38,700. And Adele can contribute to a 401k and start a Roth IRA, and you will have an additional $6,454.97 going into retirement. So the additional income will enable you to pay off your refinance mortgage in 9 years. So you will be able to go into retirement without debt. And the additional income will also increase Adele's Social Security benefit going into retirement. So sticking with the additional income, another option is that you can retire at age 62 with a wage replacement of 50% because all your debt will be retired, and an expected portfolio earning of 8.5%. So your current annual savings would be $38,700. And option 3 is without additional income from Adele, you can retire at age 67, which is your normal retirement age, and a wage replacement of 70% with an expected earnings rate of 8.5%. So you will need to save an additional $436.17 annually with this option. And then option 4 is without the additional income from Adele. You can retire at age 67 with a wage replacement of 70% and an expected earnings rate of 9.8%. So you will have an additional $6,619.73 going into retirement. So some issues, long-term issues with the education is that the cost of private education and your requirement needs, the additional annual cost is extremely high, and that's what the additional income from Adele as well is still really, really high. And so the children may merit or receive financial aid, or to help lower the cost, children may want to consider to live at home or help pay for some of the cost of their education. So we recommend that Adele go back to work and earn $50,000 annually. And we also recommend with Adele's additional income to retire at age 62 with a wage replacement of 70% and an expected portfolio return on 9.8%. We also suggest that your children help with the cost of education. So this slide is just a summary of cash flow adjustments with the reoccurring cash flows. And you can see the additional costs and the cost savings. And so your net annual increase will be $17,396. And this is just a summary of cash flow with the one-time cash flows. And you can see with the additional costs and cost savings, the net annual increase will be $12,164. And this slide just shows that that we address the issues of risk management, estate planning, debt management, increased savings, and long-term goals. And this slide shows you your risk tolerance questionnaire and your pass score of 21. And so for investment changes, we recommend that you sell $22,300 of the stock in your brokerage account to pay off your auto loan and HELC. We also suggest that you invest a little more aggressively to have a 9.8% return of investments. And the following slide has our suggested portfolio analysis. And here you can see our portfolio analysis, and you can see your current portfolio, and then our suggested portfolio, and then the expected rate of return and our expected rate of return. And ours has a higher rate of return than your current expected return. And this is the portfolio analysis based on your past score, and your past expected rate of return is much lower. And so this is not adequate. And this slide just shows you the income changes that were applied in the program for your analysis. And it also shows you the asset changes that were applied. And this is your expense changes that were applied. And we have your insurance changes and estate changes that were applied in the program. And here we have the cash flow changes, and we have the income statement of if Adele's additional $50,000 and then your current $138,500, and it shows you the difference. This is the summary of cash flow changes, and so this just shows you how much was changed in each of these financial categories. And this is the balance sheet changes, and so you have the before and after changes with the 5-year projection with the changes. We have the income statement changes, and so again, you have like the before and after. And here we have the housing ratios and how your housing ratio changed after the changes with the Adele's 50,000. And here we have your tax analysis before changes and then with changes. And these are your financial ratios, and all this will be discussed on a future. And here are some more ratios, and some of these ratios will be addressed on a future slide, but you're within your benchmarks. And then these ratios will be addressed on a future slide. And these ratios will be addressed on a future slide. So your emergency ratio and your current ratio are both above the benchmark, and with the excess cash, we recommend that you put it towards your mortgage so that way you can pay your mortgage down earlier and retire out of debt. The savings amount ratio was impacted because we sold most of your brokerage account, but this also gave a positive ratios for other ratios, and with a 21% savings rate, this ratio will increase with time. So the same explanation as with the investment asset, return on investment, and return on assets. And here we have the 3-panel approach recommendations, and so it just shows you your risk management and where you're at actually, your target, and what the program recommends you to do. And here you have your financial short term, and with all your financial short term, you're adequate. And with your financial long term, you're adequate for all the ones that are relevant to your case. So with final comments, you both have some time before retirement to improve your savings, and so we suggest that you retire at age 62 and have a 70% wage replacement, and for Adele to bring in additional income of 50,000. So that way you can increase your current savings to 38,700 annually, and then have a more aggressive investment strategy to have a 9.8% portfolio earnings rate. It is not feasible for you to save for retirement at age 62 and fully fund your children's private university. So the children will need to help. Adele can contribute to a 401k and a Roth, and she will also be able to deduct more on your taxes and keep you from filing a W-4. And then Adele's additional income will allot you to contribute $833.33 per month of additional payments to your mortgage to help you pay it off by 9 years and 7 months. So once you decide which retirement option works best for you, we will develop plans and address any uncertainties in the future. We are providing you with several reports and analysis for you to take with you and to review at your convenience. And please do not hesitate to call or email with any questions. You are scheduled to meet with us in 2 weeks to discuss any issues or concerns with the recommendations. Please be ready to indicate which recommendations you like and like us to implement, and we will need your authorizations. We would like to meet every 6 months to monitor and adjust if necessary. And if you experience significant changes in your situation, please let us know.